Welcome to Homeowner Soon's Rent to Own program. My name is Guy, and I'll be guiding you for your next 35 minutes on our partnership program. HOS Financial, we've been established since 2005, and up to now, we've done up to around over 1,225 houses that we've completed. As of 2015, we've been accepted into the Canadian Association of Rent to Own Professionals, the first company in rent to own in Ontario. Now, we basically have two programs. There's the purchase program and the refinance program. For the purchase program, these are basically for anybody who's been turned down by traditional financing due to numerous reasons like bruised credit, client filed for consumer proposal, or they're in a bankruptcy, or possibly they're insufficient income reporting because they're business for self. They could also be new to Canada and they're waiting for a PR card, or they could be possibly a foreign buyer. Myriad of reasons why lenders say no. Now, on the refinance, that's going to be a really popular program for the next 2 years. Why? As we know, loan to values are coming in a little bit too high due to property devaluation. And of course, you got bruised credit, and clients get into a collection or judgments, consumer proposals, bankruptcies, or simply the lender's not renewing. And there's actually no place to send them. Now, the rent-to-own path, basically what it is one payment. It's all fixed. They pay a monthly auction fee. The payment is fixed for the entire term. It doesn't go up or doesn't go down. Now, what we do provide is credit and financial education. We always have to make sure that the reason why they're in the program is the reason why they're getting out. And the good thing is we do build sweat equity as property values do climb. So we do set an appreciation rate. And normally the exit price in the future is generally below what the market value is going to be. So that gives added incentives for clients to stay into our program. And plus, they get to buy the house back at a more affordable house, and they're able to qualify for financing. And the good thing is the future down payment is actually built up during the term. So we actually take the initial down payment and boost it up to a level where the insurers or the underwriter says yes. And then we always try to pre-qualify all clients in the future, make sure they have a proper exit. Now, the critical components to all rent-to-own is a properly structured contract, because without that, chances are the insurers or the lenders will decline a file due to the wording. We always require mandatory ILA because we always have to make sure that the client is not signing under duress. They totally understand what they're getting into. So this way, there's no mistakes. And of course, like I mentioned before, the credit coaching, that's going to be important. Now, making sure all debt service ratios within industry guidelines, that's extremely important because nothing worse than putting a client into a rent to own and they can't get out. So this is extremely important for our program. Now, what are the qualifications for rent to own? The easiest way to look at it is make sure the house is no more than 4.5 times their annual gross income. So if they're making $100,000 a year, you're good for basically a $450K home, unless you got some really substantial debts, like a few car payments, that's going to push that TDS ratio right through the roof. The good thing is we have no minimum beacon score. So it doesn't matter your beacon I, beacon R, 300, or even 900. There's a reason why the insurer is turning you down. And our job is to overcome those objections. Now, income source could be anywhere from wage, salary, commission, or self-employed. We accept all. And we're basically a coast to coast except for Quebec, okay, due to language laws, and also their real estate rules are a little bit different from the rest of Canada. Now, the house itself should be prime and it should be complete. Now, we do buy houses as is, but we will not buy houses that are, it won't even pass home inspection, like they're just ready to fall over. We know there's a market for that, but that's not for us. We always have to make sure that we be able to get financing on that house, and there should be no issues. Now, the house itself should be residential, no commercial aspects, and valuations could be anywhere between $200,000 up to $1 million. Now, we will go over $1 million on an exception basis, okay? So always make sure you contact us, because the last thing I need is a $3 million house in the middle of Saskatchewan wilderness. That's not going to fly with us. Now, what are the costs of rent to own? The first cost would be our Path to Home Ownership program fee. That's $975. That's usually charged upfront after we approve the deal. They supply all the docs, we verify everything. Then we ask for the $975 for an email money transfer. Now, that money is refundable if we cannot place the file. And also, if they do go through our program and they complete our program, that also is refunded back to them at the end of the program. So keep that in mind. Okay, so this is basically to pay for the credit rebuilding. So, and also that also puts skin in the game. And of course, we'll charge a 1% broker fee up front. And of course, that's negotiable if you need to charge more and if the client allows. And that's usually charged at the very beginning, and we collect that on your behalf, and then we kick it over to the brokerage or to you direct. Now, independent legal advice, that's extremely important too. Okay, usually it's around $450. We just have to make sure that, you know, they are getting proper legal advice and they're just not signing anything blindly. Now, each deal requires a home inspection. Okay, unless it's a new construction, and basically find out if there's any deficiencies. A few deals ago, we found out the house had knob and tube wiring. On MOS, the house looks amazing. Interior has been fully renovated. Well, it looks like the original landlords did some shortcuts and they left knob and tube wiring. So we always like to make sure we catch these things, so this way it doesn't become a insurance incidents. And those are things that are extremely important. Appraisals, generally we don't require appraisals unless it's $1 million or over, or it's a private sale, or it's a refinance. Okay. And of course, the first month's payment is due up front because, again, it's an occupancy lease and we do require payment up front. Now, for documentations for wage and salary, it's pretty well standard. You go through the list. It's not that much different from mortgages at all. Now, let's go through a first example. This is a case study. All right. So on here, it's a rent to own, a $600,000 purchase of 5% down. If you notice, that 590 beacon score, 610, it's a little bit under the radar for CMHC, so they just gave it a decline. So in a case like here, it's not too bad. We're just doing a simple 3-year term. The monthly payment, when you add everything up, comes up to $52.95, and that's inclusive of property tax, insurance, and savings. Okay, so the initial savings, the actual rent portion, which is the occupancy fee, it's $4,200 a month. Now, the monthly savings is going to be $10.95. So when you add those two together, that comes up to $52.95. So in the future, after 3 years, they'll be exiting with $69,420 saved up. And that's basically roughly about 10%, because we will be appreciating a property at 4.9%. So their future purchase price is $692,600 from the $600 that they bought initially. Now, you're going to look at this and say, okay, so what are the options? If my client was an A client and if they were able to put 5% down, look at the CMHC rate. This is the floor rate for TD. So they're going to be paying a monthly mortgage payment of $39.8956. And when you start adding in the property tax insurance, it's well above the $4,200 a month. So really, the rent portion is not that bad at all. It sounds a little expensive because we are buying the house at the current market value. So let's look at the another example. Okay, so the client basically says, well, you know, I got 5% down. You know, how do I bring the monthly payment down? So we'll recommend that, hey, get yourself a 5% gift, could be 2.5% each side of the in-laws. So you're coming with 10%. Look what happens to the monthly payment. It now drops down to $49.80. So the rent portion is going to be $39.80. Savings component is $1,000. They're going to come out with $96K at the end of the term. And let's look at the comparison. If they were going to get a CMHC mortgage, you're looking at 6.71. You're looking at about 49.26 a month plus property tax insurance. it's a little bit more expensive than our rental portion. So again, keep that in mind. Our program may look expensive in the beginning, but it's actually not, especially when you take out the savings component. So let's look at the business for self. That's a big, huge chunk of business for us. That's probably about 45% of our business coming in. So these are the typical things that we're going to need: business registration, bank statements. You could go for the list. It's pretty well self-explanatory. You've done this a million times while doing mortgages. So let's look at the case study for rent to own. A $600,000 purchase, 10% down. Their BFS, we're going to run this as a 5-year term. The monthly payment is going to be $52.95. The rent portion is not that far from the other examples of $39.30. But if you notice the monthly saving, that's a little higher at $13.65. Why? We're going to bulk 20% down. Okay, so they're going to come with 10% and they're going to leave with 20% down in the future. And because we're stretching this over 5 years, it keeps the monthly payment down. But look at what happens too. The appreciation rate also goes down too at 3.41. And they're going to be buying this house back at 709,600. Chances are in 5 years time, this house is going to be worth probably 750 up to 800K. So whoever does business for self person is definitely getting themselves a good deal. So keep that in mind. This is an excellent solution for people that's doing stated income and they're not showing it. All right, so we're going to go into a refinance example right now. Let's just say this house is up in Barrie. Last year, this house appraised for $675. This year, they sent in, let's say, John Danford, and the house comes in at $600. Of course, we got Haventree on a first mortgage. We got Hosper in a second. And when you look at it, when you add the two amounts together, 83% loan to value, and your heart starts melting now. Yeah, because most of the privates are stopping at 75, and you're kind of, oh, geez, what do I do? Even worse, they got collections and judgments totaling another 16,000. So the total payout's going to be about 516, and that's like 86% loan to value. You're not going to be placing this with anybody anytime soon. Okay, unless the market changes, chances are this file is going to get orphaned, and you're going to be telling the client to sell. That's not the solution that we're thinking about. So we're going to put this into a rent to own. So because it's 86% loan to value, we could securitize 10% of the equity as down payment. We could run this for 3 years. So their monthly payment's going to be above $49.80. You've got the property tax, insurance that's already included. So the rent portion would be $39.80. It's $1,000. And they're going to have basically exiting with 96K. It's going to be about 85.9% loan to value. The good thing is that allows them to get back into a high ratio purchase, and they're also getting back into a bank. Previously, they were with a B lender and a private. So you're really helping these clients out in getting the right back track. So this is definitely a perfect solution for a refinance. Now let's look at the benefits of higher down and term. All right, so we can see through the example, the higher down payment, it lowers the monthly payment, number one. Number two, higher down payment also lowers the future exit price, okay? So this, again, builds towards the sweat equity aspect of our rent-to-own program, and also longer term lowers the monthly payment, and the longer term also lowers the future exit price. So again, keep that in mind, okay? So don't always say, well, I want to do a 3-year term and 5% down. Meanwhile, the client's got 10%, even 15%. So that will help sell the deal. Now, these are basically our FAQs. You know, how much do I need to put down? Basically, it's a minimum 5%. The more you put down, the cheaper it gets. Are there any annual reoccurring fees? Generally, no. Our fees are the $975 upfront, the broker fees. Now, we do have an administration fee at the end of the term after 3, 4, or 5 years. That's generally $1,500. Think of it as like a discharge fee for the rent to own. Okay, that's probably the best way to describe it. And that will pay for the legals to get out of this deal, especially for our investor, and any discharge costs. Now, how is the monthly purchase price calculated? That's a very popular question for most of the mortgage agents. So there's 5 criteria we look at. So we look at the initial purchase price, we look at the down payment, we look at the term, we look at the interest rate, and then we look at the property taxes. Any of these 5 things will deviate that future purchase price by the thousands. All right, so keep in mind, try never to quote that in advance. Let us do it, because it's a 10-minute process to calculate all that. Now, what are the monthly option credits? Okay, so that is the savings component. And that kind of differs from file to file, depending on your stated income versus salary income. So it could vary. Okay, so that is the savings component. Now, the most popular question from all tenants is, what happens at the end if I cannot purchase? Things happen in life. Maybe halfway through the program, suddenly something happened, maybe a sickness, loss of jobs, credit scores could go down, clients could file a consumer proposal against our advice. We've seen it all. Okay, so we have various remedies for that, like extending the term, or possibly if the property doesn't appraise, we could also lower the future selling price. There's a myriad of reasons or things happen, and then our job is to fix it at the end, to make it right. We always believe in a win-win for both sides. Now, who's in charge of the maintenance of the program during the rent to own? That's your client. Keep that in mind. Okay, so if the furnace stops working, they're going to be responsible for having it fixed or replaced. Now, what are the closing costs? Let's go over together again. $975, that's the path to home ownership fee, the broker fee, ILA, home inspection, possibly the appraisal, and the first month's payment. Those are due. And also too, tenant insurance. We'll need that as well. Now, who pays for property tax and home insurance? We do. Okay, so the normal property taxes, the $3,000, $4,000, $5,000 a year, we will be paying that. The home insurance, that's fire and home, fire, water damage, we pay that. Your client pays the tenant insurance. Who pays for utilities? Things like oil, gas, hydro, propane, wood pellets, whatever you consume, they're going to be paying for that. Now, what about condo fees and special assessments? If this condo, your client will be paying for the condo fees and special assessments. So be careful with that. Okay, sometimes you get these older condos that are like 40 or 50 years old, or possibly an apartment that was converted into a condo. Sometimes you see these things where the condo fees are like $1,500, $1,700 because it's very mismanaged. Okay, so be careful with those, because there's a lot of red flags when it comes to these type of properties. Now, what about the realtor? Always say the realtor is your friend, because again, they're the referral source. So always keep in mind that if a realtor refers you to file, you have to let us know who the realtor is. So we'll actually place them into the rent-to-own program, and they will be representing our investor, not the client. So the realtor will participate in the actual transaction. They don't lose their commission or anything like that. And the good thing about that kind of leads you into future referrals, because technically, when you think about it, a TD or BMO rep, they're not going to have this rent-to-own program. So they're okay for doing AAA clients and everything else. But what happens when there's bruises? Realtors love this because this opens them up into a new market. We're finding a lot of mortgage agents are telling realtors to dig into their database, find out all the families that got rejected from buying a home due to finance reasons. They could actually take those deals and resuscitate them back to life and turn them into money. Now, these are basically the answers to all the FAQs. So this way, you'll have that in the future. That's me on the left side. My name is Guy Liu. There's also Terry Heptich and Stephen Kelly. You could definitely reach out to any of us when it comes to a deal, or you can send it right into underwriting@hosfinancial.com. If you call us, there's the 1-800 numbers, or you could call us direct, and those are our direct lines. So I want to thank you all for watching this video. And if you have any questions, by all means to come back, contact us, give us a call, send us an email about your deal, and we'd be more than glad to look it over and send you an approval. Take care, and thank you so much.